Well, you're very welcome to the latest. This is the latest podcast, the latest video podcast with me, Paddy Delaney. Thank you very much indeed for joining me and hearing what we have to say. And this week, I'm bringing you a very juicy, what I believe is a very juicy topic, and that is the one around lump sum investing versus dollar cost averaging. And we're going to do it around €1 million invested in Ireland. So there's not too much information around about this and factual evidence based information around this. So I was delighted to get stuck into this topic, and I'm delighted to share it with you now. Before I jump in, it is absolutely bucketing rain here on the Meath Gold Coast. Rotten day. But however, we soldier on. There's no such thing as bad weather, just wrong clothing, or so the North Face clothing companies of this world will have us believe. But anyway, last week I was fortunate enough to attend the Financial Planners of Ireland conference in Mullingar, in lovely Mullingar, in a Bloomfield hotel. I'd never heard of it or come across it. But yeah, conference was great. Some really interesting speakers, some very nice people that I met, financial planners who, in fairness, super bunch. And so got some really good ideas around and from that I look forward to sharing on a future podcast. So let's get down to brass tacks here. This week, I'm going to share pros and cons of lump sum investing versus dollar cost averaging, where you phase it in ultimately. A look back, right, to see how the two different options have actually fared here for Irish investors. And I look forward to see how they could possibly fare in future. And again, no crystal ball stuff here. But also to look at how it has historically gone when markets are deemed to be high in terms of valuations, and ultimately share my conclusion around it and what I think different people should do in different scenarios. So there's quite a bit in this, but I thoroughly enjoyed it. And one final little side topic, if I may, before I jump into it. I'm delivering a personal finance training session. I don't do too many of these, to be fair, but I'm delivering one this week for one of Ireland's largest fruit producers, distributors. And I think I'm going to base it all around that concept of like euros is like oranges that we got to protect and grow and preserve our oranges for future use and enjoy some of the oranges at the moment, obviously, and in the present tense, but also to ensure that the juice is worth the squeeze in terms of making sure that we get the best bang for our buck in terms of the effort that and the sacrifice that we put in to get the juice is worth it, right? And we get our just returns and rewards. What do you reckon? We'll see. Okay, so anyway, on with this week's topic. When it comes to, if you have a ball of cash, right? Let's say you have cash sitting in the current account, whether it's personal account or business account, whether it was an inheritance or accumulated over time, or it was a sudden windfall from some other source, and you see it's getting whatever 0%, or maybe you're getting a couple or a few percent interest, and you want to try and get some more. You want to protect it against inflation. You want to invest it long term. There's really two different ways that you can get invested. One is lump sum investing, which I'll call LSI because I love an acronym. And the other is dollar cost averaging, called DCA. Both methods have their pros and cons, and each appeals to different people and different types of investors depending on their attitude to investing, their knowledge, their experience, their timelines, their expectations, and their goals. So in this piece and in this video, I will dive into the definitions of both, weigh their advantages and potential disadvantages, and illustrate specific scenario comparing these two strategies for €1 million investment over the last 2 years, 10 years, and indeed look to the US data. So my God, are you getting spoiled today? So first up, LSI, lump sum investing. What is it? So let's say you have €1 million, again, to use that example. On day one, you have the €1,000,000 you want to get invested. You just put it all in to whatever your chosen investment vehicle is. The idea here is to immediately expose the full capital, the €1,000,000, to the potential market gains, with the assumption that markets generally rise over time. And that is a prudent assumption, right? Markets, the constant upward curve with temporary interruptions. The second is dollar cost averaging, where, as we said, you're phasing it in. So you might invest a fixed portion or a certain amount of the total sum over a period of time to get invested. So rather than doing it all on day one, you drip feed it in, would be another term. So in our scenario, you want to get the €1,000,000 invested. So you're going to do that incrementally with the DCA approach. So let's say it's 250,000 every 6 months over 2 years. And so after 2 years, your million is all in and you have intent to leave it there the longer term, right? So both of these are where your intent is to leave it for longer term investment. And the objective of the DCA is to try to reduce the impact of volatility by spreading the purchase price across different time periods. And in that scenario, it's 2 years, but it can be any length of time. With a pension, normally where we don't all have accessible cash to put in our final figure on day one, you are forced to dollar cost average, right? So put in monthly, most people it's monthly contributions. Ultimately with DCA, what we're trying to do, and I love the metaphor, is to avoid catching a falling knife, right? And that scares the bejesus out of people, right? The idea of catching a falling knife, and that's why most people do DCA, rightly or wrongly. So pros and cons. Pros of lump sum investing. And again, this is general high level, but you've got full market exposure. Full amount invested on day one, you immediately take advantage of potential market growth. Boom, you're all in. Okay. Historically, global equities, to use this example, tend to increase in value over the long term. The majority of the time, majority of years, they are positive. So full exposure can potentially lead to better returns, and we'll see whether that stacks up in recent past in a moment. Simplicity. With this approach, you're straight in. You're invested, one-time transaction. You don't need to worry about timing or doing anything as a follow-up in terms of getting invested. You don't have any future decisions to make. You have made your decision on day one and you have moved on. I really like that concept. With DCA, again, I'll get to that in a moment, but it's a conscious decision almost, depending on the mechanism. But with lump sum investing, you're done and dusted. Pros of lump sum investing. The third one is potentially higher returns. Research has shown that markets are generally upward trending, as I said. So by investing a lump sum, you allow all of your capital to grow in line with the market gains from the start, assuming there are gains. Of course, there can be losses and downturns, right? But if ultimately, studies suggest that in 2/3 of the cases, lump sum investing tends to outperform DCA over long periods, depending on which research you're looking at. The cons of lump sum investing, that whole market timing risk. Okay, if you invest your lump sum, your €1,000,000 just before a market downturn of say 20 or 30%, you could experience significant short-term paper losses early in the journey, which is nasty. So you get in €1,000,000, let's say the market tanks 20 or 30%, your million is now worth 800 or 700,000 or less potentially. You're like, oh my God, I wish I had it phased in or averaged. You cannot predict these things, right? But the market timing risk can work against you with lump sum investing. Psychological stress. This is really the big one and the rationale for this debate in the first place, to be fair. Large market fluctuations can cause anxiety for some investors who maybe aren't experienced or aren't prepared or haven't got some support, whether it's a financial advisor, an investment counselor, whatever the case may be. If markets fall after their initial investment, it can be disheartening to see a large portion of your wealth decrease in value, if only temporarily. So unless the investor is experienced and has a professional advisor to help them keep their long-term perspective, it can lead to knee-jerk reactions. So somebody, for argument's sake, sees that their million has gone to 800,000 or 700,000 and withdraws their capital. They have just consolidated a very significant loss. They have perhaps destroyed any potential that they'll ever get invested again in future. And what is the opportunity cost there? So potentially massive impact if not done properly. Potential illusion of overconfidence. Lump sum investment requires conviction in the market's long-term trajectory, whatever market that is. Personally, global equities is the market. So while data favors lump sum investing in most cases, investors who get it wrong may feel a strong sense of regret, especially if their portfolios suffer significant losses in the early stages of the investment. So it's not fun. Let's look at dollar cost averaging now. And as I said, in a couple of moments, I'm going to get to specific Irish examples around lump sum investing versus dollar cost averaging over the last 10 years and US data. Dollar cost averaging, you're phasing in over a period of time. So if, for example, right, just to explain on this, so let's say you were going to go long-term investing on €1 million. So as in, look, my time frame is 10 years plus. Absolutely no need for this money, even in emergency, for the next 10 years minimum. So you could phase it. You could say, well, I'll phase it in over 2 years. So from today to this time, 2 years will phase in, and then it will remain fully invested from there beyond, right, for the following 8 years plus. So that's a way. Or you could say, well, I'll phase it in over a longer period or a shorter period. So dollar cost averaging is simply the mechanism to get fully invested, at which point you will then let it run, right? So dollar cost averaging, the pros: potential reduced volatility, right? So by spreading out the investment over time, dollar cost averaging potentially allows you to reduce the chance of making a large investment just before a market downturn. Doesn't avoid it, right? If the market downturn is going to downturn, dollar cost averaging isn't going to stop that, right? But it means that less of your capital will be exposed. And indeed, then when you subsequently do the next tranche, you're purchase more shares when prices are lower, and indeed, unfortunately, fewer shares when prices are higher. So ultimately, this smooths out the cost of your investment over the duration of the phase. This can be a pro, and in fairness, it can be a con, right? If markets are rising. The psychological comfort, again, this really is the sole rationale for many doing dollar cost averaging. Dollar cost averaging helps nervous investors avoid the potential anxiety of putting all their money in the market at once, right? That's what it does. It also potentially reduces regret if the market experiences a short-term drop after the first tranche of investment. Of course, it will still hurt, right? You do your initial investment, even if it's 10%, 20% of the total capital, that's still going to, if that hits a downturn, then that's still going to be negative. It's still going to hurt, all right? But it might just hurt less. Ultimately is the idea. And then the other pro potential is the disciplined approach. Again, I'm kind of plucking at straws a little bit with this one, but in theory, dollar cost averaging enforces a disciplined investment habit, as in it focuses on consistent contributions over a period of time. So irrespective of the market, on this date, we're putting in X amount, all right? So if you can stick to that, or if you have an investment advisor that will ensure you stick to that, then it can help develop the discipline. But if you're trying to do this yourself, as we'll see, that doesn't always work out. So what are the costs? Well, opportunity cost is the big one ultimately. What are the cons, rather? Potential opportunity cost. If the market consistently trends upwards during, let's say, the 2 years that you're phasing in, dollar cost averaging could result in lower overall returns. It is an opportunity cost in that scenario because you're keeping part of your money out of the market, all right? Sitting on cash or wherever it might be until it gets invested. You potentially miss out on growth. Number 2 is complexity in monitoring. Maybe not such a big deal depending on the scenario, but ultimately dollar cost averaging requires ongoing management to a degree to get invested. Again, not a massive thing, but it's the potential to add complexity here. It's not one and done like a lump sum investment. And this is, again, going back to my earlier point. If the markets fall dramatically, right, and you are scheduled to invest, let's say €250,000 on Wednesday this week, Markets are down 30%. You've just done, your initial 250 is down 30%. You're now expected to do another 250. You're like, oh, no, this market isn't free for all. Do you do it? Can you stomach it? Or will a nervous investor potentially balk at the idea and potentially miss a once in a lifetime bargain? We know not conventional, wisdom is knowing that we should buy those dips, all right? But do we do it? The old wisdom and knowledge, Brian O'Driscoll tomato fruit salad quote pops to mind for some reason there. But that's a real risk, that we will balk at the idea of getting in when markets are in a downturn, when in reality, that's probably absolutely the right thing to do. Lower returns in bull market for dollar cost averaging, as we said. In a rising market, DCI will underperform lump sum, no question. And that's just a massive potential con of DCA. Okay, well, let's look at the specifics. All right, enough of generalities, I hear you say. €1 million invested in passive global equity fund over the last 2 years, right? Lump sum versus dollar cost averaging. Lump sum investing scenario, and in this scenario, I'm just picking a sample Vanguard developed world index. All right, 100% equity, just for nice simplicity here to make the comparison and do the analysis. Okay, and where are we now? We're the 30th of September. So I've modeled that you put €1 million in to this fund at the end of September 2022, 2 years ago. Vanguard developed global equity index fund, and you left it there. That global equity fund has delivered total returns of 37% in that time frame. And I haven't cherry picked this, I've just picked a 2-year time frame. Could do longer, shorter, whatever. But this is what we've done. 37%. So your 1 million would have compounded to roughly 1.37 million before tax. Okay. 1.37 million. So you're up nearly 400,000 in the last 2 years if you had invested a lump sum end of September then. If you had dollar cost averaged, and in this scenario, I've assumed that you did 125,000 each quarter. So first one on the end of September 2022, and then every quarter since in the same fund. Good news is you're up, right? Bad news is you're not up by as much because you weren't in the market with all of your capital from day one. As we were saying earlier on, your value is approximately 1.22. So you're up 220,000 before tax since September 2022 by phasing, by dollar cost averaging. Dollar cost averaging ultimately has cost you approximately 150,000 in that scenario. Again, that's a very specific, short time frame, recent history scenario, but that's the reality. That's the fact. Okay. The perceived risk during a dollar cost average was lower, and you possibly stayed invested where you might not otherwise would have, possibly. But was it worth it? Was that deemed comfort worth it? Only you can answer that. So for me, I have these conversations all the time with clients about phased or lump sum. Again, at 90% of the time, it's if you have time, if you have the capital that you do not need, then the perfect time was yesterday. The next best time is today in terms of getting exposure to the markets for long-term growth. All right. So what about 10 years? 2 years is really short, right? Plus, we're in the middle of an epic bull market, right? So dollar cost averaging was always going to come off badly there. But the point again is nobody knew 2 years ago that we were going to have such growth over the past 2 years. Nobody knew that. All right. Nobody knew that. 2 years ago, we were having a shocking year. 2022 was minus 20% for equities. So people absolutely would have had concerns. Geez, are we in for another bleeding global financial crisis here. What's happening? So people that did lump sum invest in it was a courageous move. It was the right thing to do in hindsight, but it was courageous, and that has to be acknowledged. So let's go back, and again, go back 2 years. Folks are sitting on more cash and deposits. It's in the region of 150 billion is sitting on deposit, according to RTE, right? There's tons of people who are fearful of investing. We help people get invested. We help people stay invested. We help people have long-term success. That's the intent, right? Yes, there will be wobbles, but we get invested. Okay, we get properly invested, not this old halfway house stuff that I've spoken about before, which really doesn't achieve anything, doesn't avoid loss, and doesn't achieve proper gains over the long term. Anyway, moving off to a different topic there. But let's look at the last 10 years, shall we? All right, I had absolutely no idea how this is going to go. No idea. Nor did I, in fairness, did I think about the 2 year, right, in that particular scenario. No idea how the last 10 years would go. €1 million invested in end of September 2014 to now, end of September 2024. And with the guide of a professional financial advisor / investment counselor, you held firm during the many scares that we had from September 2014 to September 2024. Easy to forget the carnage that we experienced, right? Markets went up year one, markets went down year two, back to basically where you were at. Markets went along then nicely for a few years, fell during COVID, back down to basically year one's figures, right? Then climbed, then fell, and has been climbing since. But your €1 million invested in 2014 to today is worth just shy of 3 million. Yes, 2.9 million after fees before tax, right? Just by lump sum investing, right? So what about dollar cost averaging? So lump sum investment has turned your 1 into 2.9. What about dollar cost averaging? So in this scenario, again, we'll phase it in for the first 2 years from 2014 to 2016, right? And then we just let it run from 2016 to 2024. So 10 years of total investment duration. The first 2 years was the phase-in period. As of September 2024, your 1 million is now worth 2.5 million after fees before tax. In that scenario, dollar cost averaging cost you approximately 380,000 of total returns. Simply because that you did not get the full million into the diversified global equity fund on day one, which was the end of September 2014. Dollar cost averaging cost you nearly 400,000. What did it spare you from? That's the question. If you look at that picture and you engaged a financial advisor to help you get invested in 2014, and that financial advisor really held you to account to getting invested fully and properly on that date and day one, they have absolutely made you the guts of 400,000 in gross returns. No question. They've paid for themselves multiple times over. All right? Again, that's the impact of this. That's the impact. But what about when markets are high? All right? Markets, and I'm talking about markets being high in terms of valuations, right? Valuations versus earnings, not just in terms of where the index is at in terms of a number, right? But in terms of valuations. The inimitable Nick Maggiulli of dollars, his website is of dollars and data, right? So Nick Maggiulli of dollars and data in the US, he looked at the 2-year outcomes, right? So getting invested, boom, and the next 2 years from 1960 to 2022 for the S&P 500 now, comparing dollar cost averaging and lump sum investing. He did this against the market valuations at these times and compared and contrasted the impact of valuations on those 2-year returns of both lump sum and dollar cost averaging, right? So really interesting. And there's a link on the blog of this particular blog on informeddecisions.ie. But interestingly, the size of dollar cost averaging's underperformance does reduce as valuations get more extreme, as measured by the CAPE ratio, the price earnings ratio, right? However, lump sum investing has outperformed by 6% over 2 years on average over all 2-year rolling periods, even when valuations were considered high. When valuations are considered low, that outperformance of lump sum investing rises to an average of 10%. All right? And that's the reality. That is the reality, dear listener. So what strategy should you choose? Well, in the two recent scenarios that I've shown you, 2-year and 10-year lump sum investing yielded higher returns and better outcomes for investors. Dollar cost averaging underperformed and cost you returns. Simple as that. Over the past 60 years of the S&P data, lump sum investing delivered better returns. Lump sum investing has delivered better returns in pretty much all scenarios, dear listener. The difference is due to the fact that lump sum investing allows the full amount to benefit from market growth and participation for a longer period. Bottom line, that is it. It's all about time in the market, not timing the market, to use that overused, and I probably used it wrong, phrase. But that's it. That's the bottom line. Yes, DCA can help in some scenarios protect against short-term downturns, volatility, and some of the risk of entering the market at an inappropriate time. But those, to be fair, are short-term issues. Long-term, these benefits are less relevant and, in my experience, do not pay dividends, literally, right, and figuratively. If you're confident in the long-term growth of global equities, for argument's sake, and can stomach potential short-term losses, lump sum investing has been the better option for maximizing returns. End of story. End of story. The evidence suggests so, right? On the other hand, if you're worried about market timing or prefer a more cautious approach, dollar cost averaging offers a potential method to potentially ease into the market with reduced risk and anxiety. This might be the way to go if you're nervous or if you're inexperienced or if you haven't got somebody to support you to achieve that and to stick to it. It's one thing doing it, it's sticking to it, all right? Ultimately, the right strategy depends on your financial goals, your risk tolerance, your understanding, your education, your stoicism, your level of control. Whichever approach you choose, right? Investing in passive and diversified equity index funds, globally diverse, has offered an exceptional way to protect and grow our wealth for thousands of Irish investors. You know, however you invested, whether it was dollar cost averaging or lump sum investing, to be fair, was kind of secondary, right? Choosing the right asset and the right approach to the investing in the first instance was probably the more impactful. Whichever way you dice it, all I ask is that you make sure the juice is worth the squeeze. Thank you very much indeed for listening and indeed watching, if you're watching on the YouTube machine. Thank you very much indeed for listening.